Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio. We're watching gold today on Wednesday, having bounced off the number that we'd been talking about for so long, around 1680, and it's back above 1700 today, around 1707. Silver went down into the mid-23s and is back up well above 24 and about 24.40 today. Platinum, same type of action, bouncing back up to about 1187, and palladium 2630.
So the big question, of course, this week, are we having a double bottom week or are we having a continuation down week?
Good question.
That's a really good question. Thanks, because, well, go ahead, Miles. Answer that for us.
No, that's it. I'm done for the week. There's your technical analysis.
Last week was so fundamentally heavy, right? We got a little sidetracked on just the fundamentals.
Well, because the week before we got that resistance level or support level bounce. So it made sense to take a minute and just kind of readdress why we do what we do and look at some of those reasons, because we don't know yet. We didn't know last week. We don't know this week. We didn't know 2 weeks ago. We knew it was going to bounce. We've been talking about a bounce there for a while. We just didn't know how aggressive it was going to be. And there are some fundamental things that have occurred in the last week that would cause gold to push back down like it did. So, like I just asked, are we having a continuation week where the short-term bear market continues amidst the bigger bull market? Or are we going to have a double bottom and it's going to continue the long-term bull market?
I would prefer that it's double bottom than resume the long term, because I'm very encouraged. Can I have my 24 hours of encouragement of bouncing right off of your support level that you've called for?
I will let you stay on my lawn for 1 week.
March 11th, March 4th, actually, March 11th, March 18th. All 3 weeks you have had this figure that we bounced off of yesterday in predictive fashion. And I know that doesn't answer, is it going to hold? But at least today we've seen a nice $30 pop off of that level. So do your best to answer your own question if you don't mind.
I think it's too early to tell because it was just yesterday on Tuesday that we hit that 1680 level with gold. So I think it's too early to tell whether this is the double bottom and it's going to continue higher from here or if this is just a little bounce off that 1680 number. Too early to tell in my opinion. It's only $20-$30 up from there. So I think it would need to really continue higher from the 1710 level to show that this is a double bottom. So I'm hoping that it actually goes lower because I'd like to buy a little cheaper. But hope isn't a good investment strategy, right?
No. It is a good presidential campaign, but not a good investment strategy. Yeah, and I think that's why for the last month or so, we wanted to emphasize the fact that the 1678, 1680-ish mark really is your most shallow long-term correction point. And one of the big things that we did talk about a couple weeks ago is as we push into this, this isn't your, as I like to say, back up the truck moment. This is your make sure you're taking action here with the expectation and potential of taking action at lower prices. Because if this is a turnaround point, you do want to be able to say, hey, at least I bought something below 1700. Because now you're going to have to step in at 1806 or 1975 to pick the rest up. But if it continues down, and we'll look at some of these levels, let's say 1588, let's say the Elliott wave number we talked about a couple weeks ago, 1455, which also line up with some of the Fibonacci traders. If we see some of these lower prices, you want to have a little bit left in the gas tank to come into the market at that time as well.
I'm so glad you said that because that is what yesterday represented for me and many of my clients was add to ounces day, don't add everything you've got, right? So hold, let's add ounces, pause a little bit, see what plays out. Like Robert said, too early to tell. And yes, from a dollar cost averaging standpoint, you hope it comes a little lower. From a full position taken and you're just in as many ounces as you know you're going to be able. I know it's a long suffering that you've got to weather as we sort of move sideways and down here. Miles, I'm going to pick up on something you just said, though. You said this is the most shallow correction in the long-term charts.
Sure.
Can you explain to us time frame wise, what are you looking at as long-term, intermediate term, and short-term?
Yeah, I can. So long-term is going to be the first higher bottom we put in way back in December of 2015. So that's when we, without knowing it till a couple years later, but that is technically the end of the previous long-term bear market and the beginning of the new bull market. The problem is you don't have confirmation till you start pushing to higher levels, which didn't really happen till 2019, but it's always easier to go back and look in hindsight. So if you look at that December 2015 bottom and you look at the new high that we put in gold last year at 2075, we are at the 382 fib, right at around 1678. Now what's interesting about that is the medium-term move. So I would classify the medium term as the last bottom we put in prior to confirming that we are in a bull market. So this would be the last bottom that was put in just before we broke above the old bear market ceiling.
Was that also in 2019 then?
That would have been in May of 2019.
Okay.
Where we put that bottom in, we broke above the bear market ceiling, we came back down, tested the bear market ceiling, and then continued up. So right before we broke that, that would be your kind of medium-term range, again ending at 2075 last year where the old high was. Lo and behold, within a few dollars of that long-term 382 fib is the medium-term 50% line.
Okay, gotcha.
And then finally, the short term would be the last burst movement we had in the market last year. So that would have started following the March COVID decline, where everything kind of fell off the table right there in March, turned around and bounced back up. So from March of 2020, again up to 2075, what do you know, right at the same pricing level, you've got the short-term 618 fib. So you've got the short-term 618 fib, the medium-term 50% line, and the long-term 382 fib, all within a few dollars of each other. So that was the idea behind why I thought this would be a very, very strong possible support level, or at least initial support level, in the long-term bull market.
Yeah, and what you're talking about there is the retracement off the high. So from the bottom to the top, whether this is long-term, medium-term, short-term, it's from the bottom to the top, and then the retracement back the other direction.
Correct.
So basically, the 382 fib is a 38.2% retracement from the peak.
Yes.
The 50 is a 50% retracement from the peak, even though a different term chart. And then the 618 fib is a 61.8% correction from that peak in the short-term chart. So Miles, can you explain to me, if I understand that right, can you tell me why does that work?
Why does Fibonacci work?
Yes.
No idea.
Okay.
Don't care either.
It's in nature too.
Yeah.
I know that.
It's because a bunch of bankers hired a bunch of MIT and other graduates who are tech computer guys, and they said, figure out these formulas, and they all put these systems together, and the computer just trades the market. So everything is computer based.
Sure.
Is that right?
And that's, well,
Could be.
you're not
Partially
entirely
right.
wrong,
Right.
right?
It just always has been a Fibonacci influence in the market.
Yeah, so the question is, does it actually work in markets, or is it just a self-fulfilling prophecy? We don't know, but it doesn't really matter because it's the momentum of quantity of traders, quantity of dollars getting moved, and lots of people use the fib. So it is something that I like to look for. Of the 3 or 4 different indicators I use, it's kind of one of the big ones. And then, like I've talked about in the past, I look for places where different groups of traders who are focused on different indicators all kind of congregate around similar pricing. So you look at price action, what has happened at this price before, what are the Fibonacci levels doing? Do you have things like MACD or RSI that are showing any type of activity in that price range? And then you just stack these things on top of each other, and you can say, okay, well, all of these traders are going to place a trade here. All of these traders are going to place a trade here. When you see 4 or 5 or 6 different groups, looks like a pretty good price. So with that being said, where else could we see some good prices in gold?
Took the question right out of my mouth.
If this is going down further, and I would argue your next 2 support levels, so if the first time you're buying is at 1678, the next time you're buying is at 1588, and the next time you're buying after that would be 1455, and 1455 would be my all-in number. And I know we talked about this a couple weeks ago. The Elliott wave guys are on that same, their ABCD wave. The Elliott wave guys are also targeting down around 1455 as a potential big, full retracement correction, to use Robert's words.
Robert, you got to get him to stop giving these numbers. I feel like he's single-handedly driving the market down. I'm tired of looking at these pullback charts. When do we get to start talking about resistance again to the upside?
So someone's got to be the curmudgeon in the group, and I'm fine with the job.
Well, it shows we're not perma bulls.
Yeah, well, the dollar's wanting to rally, and so the dollar index going up is somewhat putting some pressure on gold and silver prices in dollars coming down. And so the dollar jumping over there has a previous high around 95. So this rally in the dollar that we fairly well predicted has some legs to it, pushed above 93 and previous high 95. So it looks like it's moving towards 95, and we'll see if it wants to push through there and then push up into the 96 level, or if it wants to stop. But if it were to fail that previous high and then turn lower, I think it's pretty well evident that we may be putting a bottom in gold.
Tori's in the studio pumping his fist every time somebody says bottom in gold. I love it.
Yeah, we've also, during this period of time, seen the ratio increase to 70-1 on gold to silver. So congrats to any of those of you who were able to take advantage of at least an initial little trade here and have seen that 8-point increase in the gold to silver ratio. That also is a little too early to predict where it goes until we get some of these other questions answered on final support and final bounce points. It's going to be a little tough to predict from here. Does the ratio go back up or go back down?
So on the ratio discussion, I guess it's only fitting we move over to silver. Silver also coming down. Now, silver being the more volatile metal, the highs are going to be at least percentage-wise higher. The lows are going to be a little bit lower. But silver in the short term, actually, where gold is now at that short-term 618 fib we just talked about, going back to the last low in silver on November 30th of last year. Silver is actually all the way down at the 786 fib. So really the first major floor support after silver reversed back on November 30th, posted some good support around 23 3/4, 23.75. Came down and touched that for the first time here this week, and as Robert said at the opening of the show, is now pushing back up, possibly closing in on 25. Silver has never really put in a lower low. You know, we put a low in back in September, put that low on November. Very close, but didn't get lower. Put in a higher high. Silver keeps climbing. Silver's still in a bull market, even though gold has been in a bear market. So, and I think that's why you're seeing this ratio compressing, getting from 90 or 100 all the way down into the low to mid 60s. So we are seeing a little bit of a bounce, but I think the trend has changed. I think silver will be playing catch up with gold and continues to look like the let's not say the substantially better investment like it was 6 months ago, because long term, 30-year average, I know we were talking about this, Tori, last week. I think your 30-year ratio average is somewhere around 60 to 65. But we are at that midpoint. So for those of you that have been heavily stacking silver, good on you. But it is time to start bringing some gold into the portfolio mix. And then as that ratio gets lower, you start to transition a little bit more that direction in anticipation of making a big ratio trade coming out of a large percentage of your silver and increasing your total number of gold ounces you could have bought to begin with.
I'm going to point something out that you just mentioned. And you said gold is in a bear market. You said silver remains in a bull market. Gold's in a bear market. Thank you.
Short term.
I wanted to hear the clarity.
Short term, medium term, long term.
Thank you.
That's
Short
the
term
title
bearish.
of the show this week, maybe. And rounding out the metals this week, we will take a brief glance at platinum, because platinum, like silver, remains in this higher low mentality. We put in another higher low around 1150, 1160 last week, and it's actually bounced nicely and looks like it may be putting in a higher high here. So platinum continues to climb until proven otherwise. Silver continues to climb until proven otherwise. Gold, the beatings will continue until morale improves, but gold on a long term, sorry, Tori, short term,
Thank you.
because on a long term, gold is still incredibly bullish looking forward. And one final note on the charts until we cover other less, let's say, technical aspects. While gold's putting in this double bottom, I think it's worth looking at the Dow, because the Dow put in what could be a double top. So if we see gold continue to push up from here, not saying it's going to, but if we were to see gold continue to push up from here, it's likely we would also see the Dow start to push down from here, which is something that we're all anticipating. Now, inflation is going to keep the price of everything up. So here's your real question going forward, far more important than what price is gold going to and how much money do I get to make in my gold. Much more important question to ask right now is, what has more power, the Federal Reserve or the natural movement of markets? Can the Federal Reserve and the printing press overpower what should be naturally happening in the markets? It's already proven that it can for the last couple years, but the question is for how long, and what is the catalyst that eventually causes that to break? What is the, say, international economic fundamental catalyst that causes natural markets to overpower manipulated markets?
Yeah, Miles, that is a massive question. That is, I think, on the minds of everybody, because the Fed seems to be in control at times. The market seems to be in control at times. And I'm going to take a stab at that in that conceptually, if you had the Fed print so much more money that became more than what's already out in the markets that's not in their control, then I guess, yes, they could take over control of the forces of the market because they print so much money and have control of more and more. So it's basically inflating away the market's power. Right now, I think the market, with evidence in the bond market, has been in control in a lot of ways with the bond market. Interest rates rising, the Fed trying to quell that. But that's a huge question. I don't know that we can really answer that right now.
I don't know if you can either. And what the Fed needs as its primary tool for that money printing is the distribution, the direct injection from a target standpoint. And that's where the government comes in. That's why you hear no discussions anymore about a debt ceiling. They won't even debate it because there cannot be a debt ceiling. And the federal government has to be able to spend at will as laws get passed, obviously. But that's where that money most pointedly gets to Main Street and you and I.
I think a lot of our listeners will relate to the idea that what the World Economic Forum wants to do with the Great Reset may put an end to the question that Miles is proposing about the Fed having more power than the market or the market vice versa. What they want to do there, could that be that you just don't have that as a relevant topic anymore? Because it seems like they want to make such dramatic shifts in our entire world economy that the powers and the market and those types of things are going to be controlled in some way. So we'll leave that bigger discussion to Dave McElvaney on the weekly commentary, because it's likely a topic he will address and have conversations about going forward this year.
That's going to do it this week for Golden Rule Radio. If you liked what you heard, hit the subscribe button, ring the bell. You can find more info on our website at McElvaney.com. We're on Twitter at ICA Gold or Facebook at McElvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of the advisors here at McElvaney ICA, you can give us a call at 1-800-525-9556.
Thanks for listening. Have a great week.